What's up, everybody? Joe Brown here. This is the Heresy Financial, and the numbers just came out. The United States GDP declined by 1.4% during the first quarter of this year. That means if things keep up along this pace, we are in the recession already. It is happening right now. So let's take a look at the numbers, at the data, and see why the experts are saying no, this is not a sign of an actual recession. Ready? Let's dive in. But first, a word from today's sponsor, Masterworks. In today's volatile markets, it is more important than ever to diversify. And one of the best investors of all time, Ray Dalio, he's the head of Bridgewater, which is the largest hedge fund in the world. He talks about diversification and says, real diversification is having uncorrelated assets, because if you have 500 different assets that you own, but they all move up and down at the same time to the same extent, you have no real diversification. What you really have is one position, because everything moves up and down together. The key to having real diversification is having uncorrelated positions so that they move up and down independently of each other. They are uncorrelated. Modern art and contemporary art fits this bucket, especially as compared to traditional investment vehicles like stocks, bonds, and crypto. The problem is that historically, investing in art has been reserved for the ultra wealthy, simply because pieces of art that you know are going to be worth something long term tend to cost a lot of money. So the only people who can afford to diversify some of their wealth into pieces of art like this are the ones who already have a lot of wealth. But Masterworks is changing all that. Revolutionary new platform that allows anybody access to invest in contemporary art, in blue chip art by artists like Banksy, Picasso, Van Gogh, Jean-Michel Basquiat. And I know I probably butchered that, but the reality is that Masterworks is allowing everyday average investors to put a very small percentage of their overall net worth and diversify into blue chip art. You buy a fraction of a piece of art that's been securitized with the SEC. You own this art, and they even have a secondary market for art that you can sell those shares of the art later. And as Masterworks is the largest buyer in the art market, their track record is 14.3% net of fees since inception in September of 2019. And there is a wait list, but if you would like to skip the wait list for yourself, go ahead and sign up with my link just for you in the description below. All right, so GDP declined in the US by 1.4% during the start of this year. Now, in 2022, we've had one quarter so far. The thing about a recession is that you need two subsequent quarters of declining GDP for it to classify as a technical recession. And so we've had one quarter of that. That's freaking some people out. The markets largely shrugged this off. But some people are coming out and saying, hey, just because we had one quarter doesn't mean we're going to have another quarter of decline. Don't freak out. Doesn't mean we're in a recession right now. Time will tell. I believe there's a pretty good chance that we'll continue to have a decline in GDP throughout this next quarter because of the reasons why GDP fell in the first quarter. So let's take a look at some of those reasons. The first reason we're going to look at is this, the United States inflation rate. And so this is going to impact real GDP numbers, which the nominal GDP increased, but when you adjust it for prices going up, we are going to see a decline for the first quarter. Obviously, in the last month, we had 8.5% year over year inflation. That means from March of 21 through March of 22, prices went up 8.5%. And so because prices have been rising so rapidly, especially compared to the last few decades in the US, that has a deflating impact on the GDP index. And so as prices go up, you have to adjust for that on the nominal GDP numbers, and that results in a decline in real GDP activity. Now, the next big reason that we're going to look at here is the trade balance. If we take a look here at the trade surplus or deficit, this black line at the top here is zero. And so we haven't had a trade surplus in decades in the United States, and the trade deficit has gotten much worse. What is the trade deficit? So keep in mind, this is not the budget deficit or surplus. This is the trade deficit or surplus. So it adds up all the things that we buy from other countries and adds up all the things that we sell to other countries, takes the difference, and we buy much more from other countries than they buy from us. Now, this brings up the classic, the age-old question on who is screwing who here, because we as a country are printing a lot of money, we are exporting that money, and we are getting real stuff in return for it. So we're giving the rest of the world paper, just fugazi, meaningless nothingness. And in return, we're getting real stuff. But then we have to complete the full circle here. What is the rest of the world doing with that money? If we take China as an example, China is investing all their dollars, not all their dollars, but a lot of their dollars in assets, in rare earth mineral mines, in infrastructure, in developing ties with other countries, in developing trade relationships with countries all around the Eastern Hemisphere. So they're getting useless dollars, but then they're exchanging them for assets, and what they're giving away in order to get those dollars is consumable goods. U.S. consumption makes up about 70% of United States GDP, and that is consumption. So we're consuming goods that just end up in the dump. They end up in the landfill. They're, consumable. And so that makes up a massive chunk of our GDP. We are sending away dollars, getting consumable goods that end up in our dumps. The rest of the world, especially places like China, are using those dollars to invest and get assets. So they're giving us trash, or what will end up being trash, and they're getting assets in return for it. And so, yes, it's a game that everybody enjoys right now because everybody likes it. The United States likes it because we send worthless dollars and we get stuff in return. China likes it because they get worthless dollars, but they get assets in return. At some point, though, this game runs out. It's a question of when, not a question of if. And right now, we can see our trade deficit has gotten much, much worse, meaning that we are sending out way more dollars of stuff versus the stuff that we are sending out. And so this is making the problem much worse in terms of our GDP in the United States. Now, some of the experts are pointing to a third reason as to why we had a drop in GDP, and they are pointing to restraints from exports and government spending from state, federal, and local governments. And a big part of this was an 8.5% pullback in defense spending. And this hints at the future of where things are going in terms of fiscal policy. But basically, this is taking a page out of the MMT book. This is saying that all government spending, every trade budget deficit for the government is a budget surplus for the private sector. And on paper, technically, that's correct. But just because that's correct on paper doesn't mean it has the implications that it's trying to communicate. So, for instance, when I spend more money this month than I make, that is a trade surplus for the rest of the economy. It's a deficit for me. It's a surplus for everybody else on net together. That doesn't mean that it's a good thing. That doesn't mean that it's going to build things. That doesn't mean that it's going to contribute to long-term growth, long-term success. If Google spends more money than it makes in a given year, then yes, that is a surplus to the rest of the economy as it's a deficit to Google. So just because the government is doing that doesn't mean it's a net benefit to society, number one. Number two, what it leaves out is the fact that every single person's income is another person's expense and vice versa. And so if Google spends more money this year than they made, they're either spending past surpluses or from their budget that they've saved, or they're spending future surpluses with debt. And the same thing happens with the government. If the government spends more money this year than they make in taxes, all that means is that they're either spending last year's savings, which they don't have any, so that's not happening, or they're spending next year's savings, which they are not going to have any then either, but it's just debt. And so they are borrowing that spending power, that purchasing power from the future, bringing it into the present. So then you have to ask, well, where is that purchasing power coming from at all? If they do end up having a surplus to pay off that debt, or if they don't, where's that purchasing power going to come from at all? And the answer is it's a wealth transfer. Whether it comes from taxes or borrowing, all government spending is a wealth transfer. They're either going to take it from your paycheck, they're going to take it from Aunt Sally, and from her, she's going to put her savings into a treasury, or they're going to take it from an institution that looks for a place to hold their money in a safe investing instrument by buying treasuries, or they are just going to print it. Either way, it is a transfer of purchasing power from the private sector to them. And so it's like you're taking a little slice of everybody's purchasing power. As the government, you're taking a little slice of everybody's purchasing power and then redirecting it into spending in certain areas. So it's a net benefit for certain areas, like maybe healthcare or military spending or other types of spending that the government does, politicians' paychecks. but it's a net drag on everybody else who had to have their purchasing power transferred to the government to pay that. And so this equation of, hey, every time the government has a deficit, that's a surplus to the rest of the economy. So if the government slows down on its spending, that's actually bad for everybody, because we see, like right now, a drop in GDP. Really, it's missing the biggest part of the equation, which is, where do they get their purchasing power in the first place from? It comes from everybody. And so the less government spending happens, period, the more purchasing power is left over for the rest of the economy, for the private sector. And then finally, why I believe that we are not going to see an increase in GDP for the next quarter. We're actually going to continue to see a slowdown, and it will be looked back on right now that we actually are in a recession, is because of this chart right here, the federal funds effective rate. This is the base interest rate that the Federal Reserve targets. We can see back at the height of inflation in the 80s, they got up to about 20% there, 19%. And ever since then, they've been on this decline here. Now, they dropped interest rates multiple times, and every time they tried to raise them, something happened that caused them to have to lower them again. They tried raising them here, something happened, they had to lower them again. Then they tried raising them, and then something happened, and then they had to lower them again. Right around here in the late 90s, what we get to is when Greenspan lowered the interest rates in order to deal with the dot-com bubble burst. So he lowered the interest rates to right here, 1.75, 1%, which they had never been this low before, and that fueled the housing bubble, was planting the seeds for the financial crisis. Then they started raising interest rates because things were getting too hot, and then everything started to collapse. So they had to drop interest rates down to 0 in order to deal with that. And then time went on, and they kept on saying, we're going to raise interest rates, took a long time. Finally, they started raising interest rates, which the only reason they were able to do this here without crashing the markets faster is because of the Tax Cuts and Jobs Act when Trump got elected, because there was now a little bit more slack in the economy from that, from less capital going to the government for taxes. More of it could be sucked out now from the rising interest rates. And so that's why they were able to do this for much longer than many people expected. But as you might have already known, things started to collapse at the end of 2018, and that's when the stock market started to crash at the end of 2018. So they had to say, okay, we're not going to raise interest rates anymore. And then in 2019, when the repo market started to fall apart, they had to lower interest rates again, start up QE again. And then obviously a couple months later, when COVID hit, they had to drop interest rates down to 0 again. And now they are just now starting to raise interest rates again. Now, the market says that they're going to get interest rates back up to like right here by the end of this year, 2.75%, which is higher than they got to back in 2019. So the question is the economy stronger now than it was in 2019 or weaker? Is it more fragile or more robust? By pretty much every measure, it has to be more fragile now. There's more debt right now than there was back then. So raising interest rates causes debt service costs on the entire economy, the entire government, and corporations and households to be that much more painful. We are also now seeing massive price and wage inflation. That is much more fragile than it was back in 2019. We are seeing higher taxes, again, more capital being sucked out of the economy. That's more fragile than it was back then. Not to mention all the moral hazard, the misallocation of resources, the malinvestments that have happened over the last couple of years as the money supply has expanded by 40% over the last couple of years, and interest rates have been held artificially low, and all of the bubbles and all of the misallocation of resources that happen as a result of that. The economy, by pretty much any measure that is real, is in a much more fragile place than it was back then, which means that the likelihood we are able to get up here to 2.75% by the end of this year without causing a crash is almost impossible. At some point during the next couple of months, as interest rates go up and as the Federal Reserve starts to sell assets off of its balance sheet, it will suck so much money out of the economy from just the quantitative tightening and also paying off of debt, that deflationary force. It will cause things to collapse even further. And we haven't seen enough of this yet to have any meaningful impact on consumer prices, because monetary policy takes a long time to hit consumer prices. And so we haven't gotten to that point yet. We're probably at least 5-6 months away from consumer prices starting to come down as a result of these deflationary forces. They'll hit assets first and GDP. So I think there's no way around the next 3 months showing a decline in GDP, which means that we are in the middle of a recession right now. And further, I think within the next 6 to 9 months, we are going to see some major collapse start that will cause the Fed to reverse course. But we will have to wait and see. Time will tell. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.